Welcome back to our chapter 9, and now we're actually going to analyze and differentiate between debt and equity. If you remember our accounting equation, assets equal liabilities plus owner's equity. If you finance through liabilities, that's debt, and if you finance through owner's equity, that's equity financing. So for example, retained earnings would be equity financing, stock is equity, but now if you're issuing notes or bonds payable, that would be liability. So basically for retained earnings, that's when you're very profitable and you have company that you have cash that you can use. Very low risk strategy, doesn't involve any debt. Same thing for issuing equity, you really have no liability or interest expense. It is less risky, but it's definitely more expensive because you have to have the stock, you have to make sure it's authorized, and you issue it. Now, what happens with bonds payable is it doesn't dilute control, meaning you're not issuing any more stock, so you're not really decreasing that, but there is risk associated with that. So earnings per share is and you should have like the amount of company's net income, remember revenues minus expenses equals net income for each share of common stock. So if we have this information that Southwest needs $500,000 for an expansion and they have net income of $300,000 and 100 shares of common stock outstanding, what we're considering two financing plans. One, to issue the $500,000 of 6% bonds, or plan two is to issue 50,000 shares of common stock. And management believes the new cash can be invested in operations to earn about $200,000 before interest and taxes. So we want to show you the earnings per share advantage. So here you have the borrowing and the issuing of stock. Notice in plan the earnings per share for the expansion here, it would obviously be lesser in plan 2 because we're diluting it by the additional number of shares, whereas if we issue just the bonds payable, then it really has no impact on that piece. Very common ratios that we have are the debt ratio, total liabilities divided by total assets, and then leverage is your total assets divided by your total stockholders' equity. And so the leverage ratio is known as an equity multiplier that basically shows per each asset dollar the amount of stockholders' equity. An additional ratio you should also have in your Excel. I would highly recommend you keep them all on one tab known as ratios. And then you have times interest earned ratio, which is your operating income. Notice not your net income. Operating income comes from just your normal course of business, and then your denominator is interest expense. So additional long-term liabilities that we have are basically leases. You can have an operating and a capital lease. And basically both give you the right to use the asset, but here the lessor retains the risk, and basically what you as a lessee are doing is just recording rent expense. On the other hand, a capital lease is basically whoever is leasing the asset now has the risk and ownership, and then that person that's leasing it, they can record a leased asset, and then they have to record the long-term liability in this case. So capital leases have several criteria where they transfer title to the asset at the end. So any one of these four qualifies the lease to be a capital lease. If there's a bargain purchase option, usually that's $1, right? So okay, at the end of the life of the lease, you can purchase the asset for $1. Then the lease term has to be 75% or more of the estimated useful life of the asset. Meaning if the asset has 10 years, and there's a lease for 7.5 years or 8 years, that would qualify. And then your present value of the lease payments is 90% of the market value of the lease. Pensions and post-retirement are other liabilities where you are recording the expenses when employees work, and then the cash is contributed into their pension plans, and this keeps growing for payments to the employees. And now, lastly, we're going to talk about reporting the liabilities. As you see here, there are several new items to our income statement. We've had before accounts payable, accrued liabilities, notice air traffic liability to get to our total current. And basically, we see that piece here. And then our maturities in total are here. And basically, these are all the different long-term. And notice that's a note. So this is your balance sheet here with the corresponding notes that all match. And then you generally accepted accounting principles GAAP basically tells us that companies have to report their fair value, and so the fair values of publicly traded debt and fair values determined by market price. And then our financing activities in our statement of cash flows, as you see here. And here you have the repurchase of common stock, which is known as treasury stock, and payments of long-term debt and any other financing that we have. And this concludes our lecture for Chapter 9.